This is my stock portfolio, and in this video, we'll be filling in this pie chart with the top 8 stocks to buy now, including one new stock that's up 140% this year, but might be ready to double again, and one stock whose unstoppable rise has led it to be called the next Nvidia. So a lot of these top stocks are in tech, just like my personal portfolio, which for transparency, here is my portfolio. We can see that it's up around $8,000 over the past week, but if we zoom out a little more, it's only up $11,000 over the past 3 months because there was this big drop off in July due to CrowdStrike kind of melting down. We have seen a decent recovery since then, and over the past year, it's up around 52% overall, so pretty decent. But fair warning, my portfolio does have big swings down and big swings up because I'm very concentrated in my circle of competence in technology, which is how the greats like Warren Buffett like to invest. So that's where we'll start, with an AI stock that's made me around a 50% return in the 4-ish months that I've owned it, but still has huge potential upside. Palantir. So this stock has done great over the past year, but before we decide should we invest in this stock now, we need to understand why I think the market is completely missing the point with this stock. So I'm a solution architect for Fortune 500 companies. Doing cloud and AI for massive corporations is kind of what I do. And here are the 3 biggest factors that could double Palantir's stock price or cause the price to drop from here. So first, we need to look at Palantir's technology, since that's really the core of everything they do as a business. So Palantir really has sort of 3 main product lines. Their first is Palantir Gotham, which is sort of their AI and data platform for governments and militaries around the world. This is basically Jason Bourne turned into a software platform. Second, they have Palantir Foundry, which they call the ontology of the modern enterprise, which is just a fancy way of saying it understands how all the pieces of a big company fit together and how it can use that information to make decisions. But on top of all of this lies Palantir's secret weapon, which is called AIP. This is their AI platform that runs on top of the existing data infrastructure that Palantir has set up and is able to make real-time decisions around what is actually happening in a large organization. This is probably the most advanced AI that's actually practical and in the world today, because when it comes to AI, the most important thing is data, and Palantir has been dealing with data for a very long time. This is why Forrester has recognized Palantir as a leader in AI and machine learning platform vendors, and why analysts are saying that this is quietly becoming one of the largest players in the AI market. So in the AI future that Palantir kind of sees coming, they don't see big companies like OpenAI or Google with their AI models as a real threat to their business, because Palantir is not focused on developing new, smarter AI models like GPT-5. Instead, they're focused on using these models in the real world. In fact, Palantir has gone so far as to say that the AI models being built by the likes of Google, Microsoft, and Meta are just going to become commodities in the long term. Basically, they'll all be basically as good as each other, and so you won't be able to charge a premium for one versus the other. Whereas if you're like Palantir and you have deep integration with deep data knowledge of a ton of different industries, well, you're already embedded into those companies, so you know how to make AI work for them. But even if the technology is great, that doesn't mean anything if the stock is overpriced. So that's why we need to look at Palantir's valuation, especially given the stock price is up nearly 140% over the past year, and the company is sitting just shy of a $100 billion market cap. And this astronomical rise has led many investors to compare Palantir to Nvidia, which had its own moment of massive rise back in the early 2020s, where they saw a nearly 500% rise, but that was only the start, with the stock rising an additional 1,100% from there. But what's strange in Nvidia's case is even as the stock price rose, their earnings and revenue rose at about the same speed, so the stock wasn't actually getting more expensive, it was kind of just matching the market. And Palantir's case, we do see something kind of similar. So Palantir's stock price is up 135% over the past year, but Palantir's net income, which is just a fancy word for profit, is up 376%, which means on a stock price to profit ratio, the stock is actually half the price that it was a year ago. Of course, the other way we could look at this is based on revenue, and in this case, while the company is growing quickly, it's up around 27% year over year. So by that metric, the stock price has gone up fairly substantially. So whether or not this rise means Palantir is now too expensive to buy in, or if this is its Nvidia moment and the stock is about to explode from here, might depend on the third factor. So I broadly labeled this section acquisition, but it's basically who is buying up the shares in the company. So earlier this year, a company called Wiz walked away from a $23 billion deal with Google to actually IPO instead. And when this happened, a lot of people kind of thought, if Google's willing to pay $20 billion for that company, maybe a massive company like Palantir could also be an acquisition target. So I looked into this theory a little bit, and it seems like Wiz aligns a lot closer with a company like Google. They have cloud security products, they also have AI, so it all kind of integrates better with the cloud, while Palantir isn't really focused on that same area. Plus, after Palantir's price rise, they're really hard to acquire, and I don't know if Google would get the same value from them as Palantir just going off on their own. But that doesn't mean there isn't the potential of share acquisition, mainly because Palantir was recently added to the S&P 500 as of September 23rd as part of the index's quarterly rebalancing, which means the big players, the hedge funds, the teachers' pensions can now buy up this stock, whether it's part of an ETF or just because it meets certain criteria that allows the big investors to invest. They're not going to buy a stock that isn't profitable, but a stock like Palantir that makes a profit, is growing quickly, and is added to the S&P 500, suddenly it looks a lot less risky to these big investors, which just opens up the market for who is willing to invest in this stock. So that could mean we see a big boost in the stock price. We've already seen a pretty big boost since they were first added, but it could also mean some underperformance in the 1 to 2 year period. There's something known as the S&P 500 curse, where basically companies added to the index tend to underperform over the following year. Just look at Tesla as an example of this. So I love Palantir's technology, but that's why I've been in and out of this stock recently after their big rise, but I'm excited to see where they go next. But that leads us to stock 7, a company that's in close partnership with Palantir, boasts a $3 trillion market cap, and you might have one of their products open on your other screen right now. Seriously, how many of you guys are working while watching this video on the side? I see you, it's fair, I do the same thing. But let me know in the comments if you happen to be using this next company's products right now. So stock number 7 is Microsoft. They're known for their personal as well as business-focused products, ranging from Microsoft Office to Microsoft Teams to Microsoft Azure, and their massive investment in ChatGPT creator OpenAI at the beginning of last year. But because everyone already talks about Microsoft's cool AI technology, or how they're making a bunch of money off of enterprise users, the way that we can get an edge in this stock is by understanding how Microsoft uses their ecosystem to make each new product more valuable and then predict what their next big product is going to be. So for Microsoft's ecosystem, the company is huge, but they have a very consistent vision between all their different products. Kind of sitting underneath all of it is Microsoft Azure, which is their cloud platform that lets them do everything from run other companies' applications to running their own business on top of it. But in order to actually build stuff that runs on Microsoft Azure, a lot of developers use GitHub, which is the largest, most widely used developer tool in the world, and their recently released GitHub Copilot, which has now become the top AI developer tool in the world. And they're able to create this tool because they have access to more example code than any other company on earth. And if you're a company looking to build an enterprise-grade application using OpenAI's models, really the only game in town is using Microsoft Azure. And so Microsoft loves to create these competitive moats, where they take a bunch of seemingly unrelated products and they kind of create a wall around their ecosystem by forcing you to use one or more of these products in conjunction with each other. So here's how Microsoft plans to dominate what's going to be one of the biggest investing trends of the next decade. The US cybersecurity market is estimated to grow at a compound annual growth rate of 7.4% through 2030. But if we focus in specifically on the cloud security market, that is expected to grow at a rate of nearly 18% compounded per year, reaching nearly $150 billion yearly by 2031. Now, if you've watched any of my past videos, you'll know that I'm a big investor in CrowdStrike, which is one of the leaders in the space. In fact, Gartner has named them the leader in endpoint protection platforms. But if we zoom in on this little chart here, we can see that CrowdStrike is ranked in the top right in terms of both ability to execute and completeness of vision. But right behind them here is Microsoft, who has an equally strong vision and is just slightly behind them on ability to execute. Remember, CrowdStrike is a small company focused exclusively on cybersecurity, and Microsoft is a behemoth that's trying to create an ecosystem around their products. And they are catching up, or at least keeping pace, with CrowdStrike in this area. And that's not the only area of security they're really focusing on. Microsoft was also recently named a leader for security information and event management, and they are aggressively pushing into the cybersecurity space. Now look, Microsoft is a behemoth of a company, company. They did almost $250 billion in revenue just last year. But if I were to find the one product area that they still have massive room to grow that could actually move the needle for this stock, cybersecurity would be the one I would focus on. But let's take a hard left turn out of the tech space now and into a stock that's recently come across my radar that doesn't fit my usual type of investments, but there's something really interesting going on here. And by the way, I will show the full list of stocks I'm currently investing in at the end of the video. So Constellation Energy is an $85 billion plus company whose stock is up 140% for the year. That recently signed a 20-year deal with Microsoft, marking the biggest, longest deal they've ever made of this kind. And this is a stock that you can probably tell by the name is playing in the energy space. So let me throw out a few stats here. Just in Northern Virginia, it is estimated that they will need 11,000 megawatts of electricity by 2035, which has already resulted in $5.2 billion worth of investments into transmission lines and power plants in the area. And with the incredible amount of energy now going into generative AI, that is actually starting to affect the overall national power grid. Boston Consulting Group estimates that the demand for AI energy will rise by 15 to 20% compounded per year through 2030, at which point it will make up 16% of the total US power consumption, equivalent to 130 gigawatts. And the entire global utility market is only valued at $6.89 trillion today. So what does that all have to do with Constellation Energy? Well, we're seeing a trend now where big data center companies are realizing they can't just rely on the national grid for energy. They need to start creating what are called power purchase agreements, or PPAs, where companies will effectively agree to purchase a certain amount of power, especially in solar or nuclear power, and setting up smart grids specifically so that they can support the expected demand that they're expecting to come. And this isn't some far future thing. Like, this is a map that shows which states have seen the largest growth in gigawatt usage. And as you might expect, all the states highlighted here in blue that are using the most additional electricity are the states that have the most new data centers being spun up. And Constellation Energy is sitting at a really interesting intersection between several trends in the energy market. So you have increasing demand from data centers, which is why companies like Microsoft are signing these huge deals. But also, as Constellation Energy points out in this video, which looks like it's straight out of 2002, they are the largest producer of carbon-free energy in the US, providing nearly 10% of the nation's entire supply of clean energy. And the company has a goal of producing 100% carbon-free energy by 2040. But aside from just doing that out of the goodness of their hearts, there's a real investing thesis behind this. So the US government has been aggressively pushing for the growth of data centers in the US. So they know that this energy demand is going to be coming. On top of that, there has also been bipartisan pushes to build additional infrastructure in the US, which includes energy infrastructure. And then on top of all of that, the US has redoubled efforts to subsidize renewable energy, pushing them to $15.6 billion over the past 7 years. So there's been a lot of talk around how these subsidies help companies like Tesla, which gets cheaper EV cars, or even Nvidia that wants more data centers in the US. But a lot of the conversation misses the kind of boring traditional companies that are also benefiting even more directly from these subsidies, like Constellation Energy. So back to the deal now with Microsoft. The craziest thing about this deal to me is that Microsoft is actually willingly paying a premium specifically for nuclear energy from the company. As in, Microsoft is locking in a deal to pay $110 to $115 per megawatt hour, while analysts say that realistically, the market's only going to be charging around $100 per megawatt hour in the future. The takeaway, Microsoft is willing to pay a premium specifically for nuclear energy because it's cleaner. Also, fun fact, assuming this deal goes through, this is going to be the first time a nuclear power plant has ever been reactivated in the United States, which as a former chemical engineering student is super exciting and super promising for the industry. So the company already saw a quick 35% jump in their stock price after announcing this deal, but assuming more data centers continue to come online, that might not be the last jump that we see in their stock price. But I know what you're saying, we can't talk about energy and data centers without also talking about the companies making the chips for those data centers, which is where these next two stocks come into play. So stock number 5 is a company whose stock price has increased by over 400% over the past 5 years, but it looks like a value at its current price. This is an AI chip company, but it's not Nvidia. So I'm going to do a side-by-side comparison between this stock and Nvidia. So Nvidia currently has a PE ratio of 36.6. This stock has a PE ratio of 31. 1. Nvidia has a PEG ratio, which factors in growth, of 1. This stock has a PEG ratio of 0.7, meaning it's 30% cheaper than Nvidia. Nvidia has a price to book value of $57, so if you broke up the company and sold it off for parts, you would only get 1/57th the price of the stock back. This stock has a price to book value of 4.47, making it less than 10% the price according to that. And according to the company's F score, they are extremely safe, and their Z1 score says their bankruptcy risk is also safe. So that company is AMD, one of the biggest AI chip makers that has traditionally lagged behind Nvidia in the data center GPU space, but that is quickly changing. AMD has recently revealed specs for their new Instinct M series chips, the MI300A, which is the world's first data center APU, which combines GPU and CPU onto a single package. So AMD has had APUs for more than a decade, and an APU is basically just a chip that combines both the graphics processing and the central processing in one space. So to really simplify, a CPU is basically logical linear thinking. It's like a traditional computer or a calculator. A GPU is a little bit slower thinking, but spread out among a lot of different trains of thought at once. GPUs tend to be really effective for AI, while CPUs are more for traditional computing. So why would you want to put both of these onto a single chip? Why not have two chips like everyone else? Well, there's a couple potential reasons that could become even more important as generative AI gets smarter and smarter. So in general, if you have the two things on the same chip, they can communicate faster back and forth, they can share memory, there's a lot of advantages. But I'm going to go out on a limb here and predict why this new architecture could be so impactful for next-gen AI. So you may have heard of OpenAI's recent announcement of their O1 model of AI models, which I'll let run in the background while I kind of explain what makes this model special. Effectively, AI traditionally has been really good at advanced pattern matching, which makes it good at generating text, but it hasn't traditionally been very good at thinking through things step by step. The O1 model is specifically designed to improve this logical thinking, which we can see here the AI did by taking two steps, first outlining the task, then spotlighting the key GPU architectures, and then actually generating a response that will tend to be a lot more useful than the faster GPT-4 responses. So what does all this have to do with AMD and APUs? Well, if GPT-O1 is more logic-based, it's thinking more in a linear step-by-step fashion, something that a CPU can do very, very quickly. But it's then combining that with the traditional GPU-powered generative AI. So if we're already seeing AI models start to marry these two different types of thinkings, it stands to reason that more advanced AI models, say a year from now or 2 years from now, will be able to use these new types of chips way more effectively than current models can, which is appropriate because this chip is only going to go into production in late 2024. We're probably not going to see a ton of them until 2025. But AMD expects this could help them grab a huge chunk of the expected $500 billion artificial chip market by 2028. And currently, that is 90% dominated by Nvidia, so there's plenty of room for AMD to move in. The other thing that I found interesting is AMD has recently joined forces with Intel to decide the future of x86 architectures. Intel has been kind of struggling over the last couple years, but there was a period where their chips were in basically every device on the planet. But in a world where Nvidia controls 90% of the AI GPU market, it's kind of interesting to see what used to be the two biggest chip makers in the world collaborating to figure out how they can expand the x86 ecosystem. I don't think that partnership is as important as AMD's continued innovation in the AI data center space, but it is good to see that AMD is really firing on all cylinders, doing their best to catch up with Nvidia. And over the next year to 2 years, I could absolutely see them start to regain some of the market share that they've lost. But while AMD and Nvidia compete to make the fastest, most powerful AI chips for the biggest AI models, there's another company quietly working in the background to make more efficient, more energy-saving chips that AI models may ultimately pick as the long-term winner in this market. So if you have a phone or a laptop or wireless headphones that are not made by Apple, there's a good chance that you're holding a device that has an ARM chip inside of it. So ARM's stock price is up just under 200% over the past year, and they're one of the big reasons that Intel has been struggling so much over the past few years, because everything, honestly, is being built on ARM architectures nowadays. 70% of the world's population currently uses ARM-based products, with over 280 billion ARM chips shipped. Now, these are not the massive data center chips that NVIDIA is creating. ARM is very, very focused on making more energy-efficient chips that are able to run a lot cooler, quieter, and using less electricity than the larger counterparts are. And this traditional market for mobile chips is not going to go away anytime soon. But what's really interesting here is how the AI market is starting to buy these chips as well. So I showed you GPT-o1 a second ago, but at the same time, there's another model that OpenAI also launched called o1 Mini. This is a smaller model, uses a lot less parameters, but it's also faster than o1. And we are seeing time and time again that when it comes to AI models, bigger is not necessarily better. One of the big issues with just making your AI models bigger and bigger and bigger is it takes a lot of energy to run them, yes, but also no one can actually run them except the big cloud providers like Amazon, Google, and Microsoft, and no one wants them to have all the AI power. A lot of companies and even individuals are starting to focus more on smaller AI models that are more focused in what they do. Imagine if instead of having to use ChatGPT, you could use an AI model built directly into your phone. Apple Intelligence is an example of this happening right now. Meta has been a big player in this space, training smaller models that in many cases could actually outperform the bigger large language models. And so if that trend continues, the only chip maker that seemingly is even focused on this space is ARM. And they have a massive advantage even over the behemoths like NVIDIA in terms of their ability to produce energy efficient chips like those that will likely be in demand 1 to 2 years from now. And one really interesting note about ARM, I'm going to briefly show two of their numbers. Their revenue here is around 1 billion, but around 225 million of that has turned into profit. This is a very, very high margin for a chip company, and that's because ARM doesn't actually manufacture any of their chips themselves. They purely focus on designing chips, and then they license out those designs to other companies to build. This makes them an extremely efficient business model, and they're able to be fairly agile in adapting to new trends because they don't actually have to deal with the hardware itself. They're only focused on the design piece. But while all these AI model creators and AI chip makers are making these big splashy headlines, there's another stock that's happy to quietly sit back and build the infrastructure that connects all of this AI together and quietly make a fortune. It's made me just a hair under $4,000 so far, but I think that is just the start compared to what's possible. So before diving too deep into the stock, if you wanted to build an AI app, how would you go about doing it? Well, you could download an AI model to your computer, write a little AI program and just run it there. The problem is now no one else can use it unless they're on your computer. You could try to find some service that lets you deploy it somewhere, but last I checked, WordPress doesn't have an AI apps template. So as an enterprising developer, what you might do is go to one of the hyperscalers, Amazon Web Services, Microsoft Azure, Google Cloud. The problem with these is they're going to try to get you to use their proprietary AI models, and your app is only going to run as fast as the distance between their big data center and the nearest user. But if you wanted to build a free app in a couple seconds without locking yourself into one of the big hyperscalers, well, I did exactly that in my top 4 AI stocks video using Cloudflare, and they're making a big bet that a lot of other people want to be able to do the same thing. So Cloudflare touts several AI tools that you can build on top of their internet backbone. See, Cloudflare wants to reinvent the way the internet itself works, and they do this by building their own effective internet backbone that other companies' websites can run on top of. Ever see a warning like this when loading a page? Well, Cloudflare works to both run and protect websites, with 95% of all internet users within 50 milliseconds of their network. But what's interesting about this is AI apps are a lot like websites of 20 years ago. Everyone wants to own one, they're fairly easy to build, and most of them don't do anything. But just like with those early websites, the value is going to come. And so if you're able to build the shovels to create that value, you stand to make a lot of money. So one analogy I like to use is the AI app is kind of like a car. NVIDIA NVIDIA is kind of building the engine for that car, and Cloudflare wants to own the roads that the car will drive on, as well as have the ability to control all the traffic. So let's look at some of the capabilities that Cloudflare offers in the AI space. Cloudflare's AI Gateway is kind of like an air traffic control system for AI workloads. It's one thing to have the raw power of AI, but it's only useful if you have the network to distribute it to everyone else. AI Gateway makes sure that AI models reach the end user without any issues. Cloudflare's Workers AI allows developers to build the cars in this analogy, kind of like when I made an AI app that can identify cats in my last video. This means that anyone, even if all you had was a cheap Chromebook, could create an AI application and serve it out to the world. And then Cloudflare has AI security and firewall to protect your apps, as well as other tools like Vectorize to make those apps more powerful. What's interesting about Cloudflare is 30% of the Fortune 500 are currently paying customers, but the way their whole business model works is to let developers try out their tools for free, get the developers really excited, and then let those developers basically bring on the rest of their company on board and upsell them from there. It's like the world's largest freemium app. So why does this matter for investors? Well, if we look at the waves of technology emergence. So I love to use this chart as a reference. This chart shows the waves of stock prices that we saw during the build up to mobile phones. So first off, we saw the semiconductors like Qualcomm and ARM building up. These are kind of like the NVIDIAs and the AMDs of today. Second, we saw the infrastructure stocks go up. These were the Samsungs and Apples building the platforms that would run apps on top of them. This is where Cloudflare is starting to play. Then lastly, you had the software and services, which were built by Google and Amazon, and these saw the biggest rise overall. This is where the AI companies like Palantir, for example, might end up playing. But considering the massive rise we've currently seen in semiconductor stocks, it seems like companies like Cloudflare are next up on the list for their AI boost. And with 46% compounded revenue growth since 2018 and sky-high gross margins, plus a rock-solid vision of an AI future where it's as easy to build your own AI app as it is to set up a website today, it makes it easy for this stock to make my list. But there's room for another type of AI company in this last category over here, in software and services. And it's another stock that I own that competes directly with Microsoft and ChatGPT, but I actually think may be the biggest long-term winner in the AI model space. So you may remember back when OpenAI first launched ChatGPT, Google was caught kind of unaware by this. Up until that point, they had been by far and away the leader in the AI space. And outside of generative AI, they still kind of are. Google's Google Cloud Platform still has the strongest overall AI model presence of all the cloud platforms that I've looked at. The only area where they've been struggling is in generative AI specifically, but they are catching up. ChatGPT completely revolutionized the world when it first came out, but nowadays there's a lot of other AI models that can do basically the same thing. So I'm going to show you in a screen recording on my phone exactly how smart this AI can actually be. So I'll just take a picture of this exact image and send it to Gemini and see if it's able to explain what this image is actually showing. And here we go. It gives me an actual pretty accurate explanation of what this chart shows, as well as what the chart might actually mean. Now, is this something that ChatGPT can't do? No, but it's basically at parity with ChatGPT at this place, which is crazy because they were 6 months behind when ChatGPT first came out, which means they're catching up. But here's why that matters in the context of Google's overall business. Google search makes up the vast majority of their revenue. It made them $46 billion in their last quarter. But outside of the money they make from ads, the rest of their money is coming from Google Cloud, which brought in just a hair shy of $10 billion in their last quarter. So if Google is able to get their generative AI to fully eclipse ChatGPT, which I think is absolutely possible in the next 5 years, they could become the go-to platform for big companies looking to use AI in the cloud. Add on top of this the fact that they have access to probably the biggest data set in the world from YouTube plus Google search plus every Android phone that's now using Gemini built in, and Google has a huge data advantage over companies like OpenAI, especially given how many companies are now starting to push back against these big companies just doing scraping of the internet to train their AI models. Add on top of that the fact that this stock is relatively cheap compared to some of their nearest competitors. They're sitting at a PE ratio of 19.7 versus Microsoft, who is a close competitor, currently sitting at a PE ratio of 30, which is why I currently own 100 923 shares in this company valued at just over $20,000. And also, it's kind of nice that even though Google is a rapidly growing stock, they're also paying out a fairly decent dividend. And I can actually see my portfolio tracker says they'll give me $50 next year. That's kind of cool. But I've talked about Google before. So before I share my entire stock portfolio, this next stock is a brand new stock that I've never talked about before. And it ties in with what I said at the start of the video around sector risk. I am very concentrated in tech stocks right now, since I know it pretty well. But this next stock helps to offset that a little while still being my overall top stock pick for this month. So a little bit of context setting first, but it'll be worth it if this stock makes you a bunch of money. So there's two big events happening in the US right now. We have the US elections happening, and we have a lot of uncertainty around the economy and interest rates. So I want to use sort of a first principles approach to first break down how these are affecting stock investments and then how that ties in with this last stock. So to avoid any sort of hocus pocus around the economy, let's focus on what we actually know. We know that if for some reason the economy slows down close to an election, people are probably going to vote for the other guy to get into office. So if there is a cool down in the economy, there's going to be pressure to push it back up. The Fed does this upward pushing by lowering interest rates. So if you go to a bank, you would see a 3% interest rate rather than a 7% one. And when you lower interest rates, it means there tends to be more lending and borrowing action in the market in general. Now, most investors have probably heard this before, but here's how we can use it to make money. Historically, more lending tends to mean growth stocks tend to perform better, since one, these companies can just borrow money cheaper to grow faster, and two, lower interest rates mean the present value of future profits are valued more highly, again benefiting growth companies. So here's an analogy. Imagine you set up a lemonade stand next to a bank, and when people pass by to walk into the bank, you offer to let them invest into your lemonade stand. You say, we're not profitable yet, but we're going to be making a lot of profit in the future. Well, if interest rates are high, people are going to say, look, the bank's paying me 5%, I'm just going to go and do that. And they'll just pass your little lemonade stand by. But if interest rates are really low, well, people are getting less money from the banks, so they might be willing to wait a little and invest in your lemonade stand for the hope of bigger future profits as your lemonade stand grows. And it's the same thing with growth stocks. Companies that are growing quickly when interest rates are dropping tend to see an increase in their valuation. So the easiest way to take advantage of that trend is to invest into a growth ETF. And one of these that I like is VUG from Vanguard. It acts just like a stock. It gives you ownership in all the different companies wrapped up into the ETF, and it has a pretty low expense ratio. But I promised I would show you my full stock portfolio, so here it is, and make sure to follow me on Instagram, where I'm posting daily stock breakdowns and news on the market. And check out my last video on the top 4 under the radar AI stocks in the market right now.